Hey guys, what's up? In this video, I will be sharing the best stocks to buy for the month of June 2021. I absolutely love making these videos because I love sharing my research and insights on where I'm looking to invest my own personal capital. And look, I don't know who, but someone needs to hear this. You have got to stop saving all of your money. Venture into some investing if you're really serious about achieving financial freedom someday. I've done my research into tons of different companies, and these are the stocks that I believe are the best to buy right now and have huge growth potential in the future. As always, it is very important that you watch this video until the end as I give my full analysis on each of these companies' stocks. First off, I'll be going into some key metrics for each company, and next up, I'll be going into some company news that has been surrounding the stock, and lastly, I will go into my growth outlook for each of my stock picks. I put tons of work and research into this video to give you guys the best possible value, so I would highly appreciate if you can give this video a quick and easy early thumbs up, and without further ado, let's jump into the video. So to kick things off, the first company on my list is Alphabet, ticker symbol GOOGL. This is a multinational conglomerate that owns the world's most important search engine, which is Google. Alphabet also owns Fitbit, DeepMind, Google Fiber, and plenty of others. As of now, Alphabet is trading at $2,430 per share, and even though this may seem like a pretty steep stock price, you can actually buy smaller pieces of these shares, which are known as fractional shares. You can do this with apps such as Robinhood, and I'll include my link in the description down below, so just make sure to take advantage of that. Looking at Alphabet's stock price over the past year, the stock has done extremely well. Alphabet is a large cap company with a market cap of $1.65 trillion. The company also has a price to earnings ratio of 32.39 and earnings per share of 75.04, and the company currently does not pay a dividend yield. Their 5-year price to earnings to growth ratio is 1.42, along with a price to book ratio of 7.09. Alphabet is also doing well in terms of company financials. The company has a profit margin of 26.12% with a return on equity of 23.69%. Alphabet is also loaded on cash. They have over $135 billion in cash, with $28.25 billion in debt and a current ratio of 3.10. According to analysts, they have Alphabet rated as a buy, along with having an average price target of almost $2,800, which is higher than what the stock is currently trading for. So to make things clear, there are two versions of this stock out there. There's GOOG and GOOGL. The difference is Class A shares with voting rights and Class C shares with no voting rights. But it doesn't make much of a difference in my opinion because both shares will still see the same future growth. Alphabet's earnings have grown by an average of over 50% in the past 3 quarters, and the amazing thing is that they are still projected to grow by 50% this year alone. And investors love Google stock because they continue to post these big profit margins. Alphabet has also been doing share buybacks by purchasing over $11 billion of their own stock in the last quarter. This is great news for current investors because this means there is less shares in circulation, which increases the price of the current shares that are available. In the company's most recent earnings report, revenue increased by 34% to $55 billion, with most of it coming from YouTube advertisements and their Google Cloud service. I think that Alphabet will continue to grow and expand their business over the next decades. Their businesses are just too powerful, and they excel my beliefs within their company's technological advancements. I am all in on Google for the long term. They have great products, and they will only continue to innovate and release better services and technology. And these are the main reasons why I will continue to purchase Alphabet stock over the next coming decade. Next up, for the second stock on my list, we have Docusign, ticker symbol DOCU. Docusign provides cloud-based electronic signature solutions. Its cloud-based e-signature platform helps companies and individuals securely collect information, automate data workflows, and basically sign anything. As of today, Docusign is trading for $253.01 per share. Throughout the last year, Docusign stock has performed extremely well. This is a large cap company having a market cap of over $49 billion. They have no price to earnings ratio since they have not been profitable, with a negative earnings per share of negative 1.08, and they pay no dividend yield. Docusign has a 5-year PEG ratio of 3.42, along with a price to book ratio of 194.71. And taking a look at the company's financials, they have a profit margin of negative 12.54 with a return on equity of negative 53.21%. According to the balance sheet, Docusign had $780.63 million in cash, with $946.69 million in debt and a current ratio of 1.01. And according to analysts, Docusign is currently rated as a buy, with having an average price target of almost $270.35, which is higher than what the stock is currently trading for. So there are some concerns. The main question is whether Docusign's growth will slow down as the pandemic eases and business travel normalizes, but there are some good signs. Docusign just reported earnings growth of 267%, picking up for a second straight quarter. The company's revenue has jumped for 5 consecutive quarters in a row, with a 58% spike in quarter one. In the company's current quarter, which ends next month in July, Docusign was aiming for $482 million in revenue in the middle of their outlook. Meanwhile, analysts have revenue projections of $474.2 million, just a bit short of what Docusign has projected for themselves. However, the company has increased their customers to 673, with an average annual contract value of over $300,000 as of April 30th. This number has increased from 599 customers that were reported in their previous quarter. Overall, I believe that Docusign has great long-term growth ahead. With everything that has been going on in the world, companies are going to start looking for ways to make things easier for their customers, and they will also be looking for ways to make things more contactless. And the e-signing of documents is one of these things. You can fill out and sign papers from your computer without ever having to leave the comfort of your own home. For these reasons, I believe that Docusign is a company that you should consider doing some more research into and eventually investing in. Now, for the third and final stock on my list, we have L Brands, ticker symbol LB. This is an American retailer of women's apparel, personal care, beauty, and home fragrance products. Some of you have probably purchased from this company before. They own brands such as Victoria's Secret, Pink, and Bath and Body Works. As of today, L Brands is trading for $66.90 per share. Over the past year, L Brands has seen explosive growth, going all the way from $15 per share last year to almost $70 today. The company has a market cap of $18.51 billion with a price to earnings ratio of 13.37. They have an earnings per share of 5.00 and pay a small dividend yield of 0.15. L Brands has a 5-year price to earnings to growth ratio of 0.93 with no current price to book ratio. Taking a look at the company's financials, they have a solid profit margin of 10.73% with no current return on equity. Diving into their balance sheet, L Brands has $2.81 billion in total cash, $8.35 billion in debt, and they have a current ratio of 1.72. Currently, analysts have L Brands rated between a buy and a hold. The stock also has an average price target of $78.85, which is about 20% higher than what the stock is currently trading for. In their Q1 2021 earnings, they actually beat analysts' expectations, posting an earnings per share of $1.25, along with posting $3.02 billion in revenues. The company's net income rose by $276 million, with sales increasing 80% from last year. And here's some more exciting news. Later on this year, L Brands will be branching off Victoria's Secret as their own public company. They want to do this to have management focus on just one company in hopes of delivering higher profits for each of the individual companies under L Brands. The branching off of Victoria's Secret would be a positive for L Brands stock. If you are currently invested into L Brands stock, you will see a stock price drop, but it will be made up for by you receiving shares of Victoria's Secret. You can kind of think about it sort of as a stock split. Victoria's Secret has also seen a huge upside in their lingerie sales due to their more inclusive marketing to women of all sizes. This is actually a very smart idea because it allows the company to expand their customer base to more women of all different shapes and sizes. I do think that L Brands is a great stock to pick up if you plan on holding for the long term. I can see L Brands beating out all of their competitors and continue to grow over the next decade. Just remember, I am not a financial advisor. Do your own research before investing into anything. You should not buy these stocks just because they are on my list. Use this video as more of a guideline for your own research. With that being said, let me know what stocks you guys are interested in picking up down below. I hope you guys enjoyed today's video, and if you've made it this far, make sure to drop a quick like on this video and subscribe to the channel for more future content like this. I hope you guys have a great day, and I'll see you in the next one. Peace.